Hey, what's up YouTube? Welcome to my channel Chart Strength. My name is Zora Tour, and today I'm going to be talking about the month of February and how it usually turns out for the stock market. And I will sprinkle my predictions throughout. Hopefully they turn out, but we'll go over January, February, inflation, the economy, and what it means for stocks. Okay, so February historically has been a very tepid month. Even though February falls in the best 6 months of the year, November to April, its performance is actually pretty so-so and it doesn't do too well. The only standout in February is actually the Russell 2000 and sometimes the NASDAQ 100. But in a pre-election year like 2023 right now, the NASDAQ 100 and the Russell 2000 are actually standouts and they do really well. The NASDAQ typically has registered 2.8% and the Russell 2000 has registered on average about 2.7% in a pre-election year. The Russell 2000 and the NASDAQ 100 typically benefit from the January effect. My guess is due to the fact that there is a lot more optimism and confidence for smaller cap companies and technology companies. And given that we are in a pre-election cycle and there's been a lot of spending in the books, it bodes well for more speculative, smaller startup type companies. Now, before we go any further into the month of February, I think it's important to take a look at January and the formation of the January trifecta. The January trifecta is when three things come together: the Santa Claus rally, the first 5 days of January, and the entire month of January's performance. If those three things come out positive, we call that the January trifecta, which bodes really well for the rest of the year for the stock market. Let's take a look at each of these. The Santa Claus rally took place this year, which netted positive results for the S&P, the Dow 30, the Russell 2000. The NASDAQ, however, did not register a positive Santa Claus rally according to my data. Looking at the chart of the indices from December 23rd to January 4th, which was the Santa Claus rally, the S&P 500 rallied 0.8%, the Dow Jones rallied 0.7%, the Russell at 1.12%, and the NASDAQ at negative or minus 0.4%. Now looking at the chart of the first 5 days of January, the S&P 500 rallied 1.61%, the Dow Jones rallied 1.53%, the NASDAQ at 1.84%, and the Russell 2000 rallied 1.86%. Now when we move on to the month of January, the entire month, we see that the S&P rallied a whopping 6.49%, the Dow Jones at 3.3%, the NASDAQ at 10.9%, and the Russell 2000 at 9.64%. What we're seeing here in the entire month of January is momentum from the Santa Claus rally carrying over to the first 5 days of January, and then that momentum carrying over to the entire month of January. So based on that momentum of all three, the trifecta, I think that the entire year has a potential for this momentum to carry it upwards, meaning the stock market has strong possibility of turning out the year positive. So if there is any weakness in February, we might want to buy into that weakness because of the January trifecta that has just occurred. Like I was saying, when the January trifecta happens, there's an exceptionally strong probability, about 80-90% of the time, the year will finish positive between 12 to 18%, especially in a pre-election year. So if we are factoring the presidential cycle, it looks like to me any weakness in February might be really attractive, or any weakness throughout the year might be an attractive point to buy stocks because of this presidential cycle. And considering all the spending bills like the infrastructure bill, like the semiconductor bill that were passed, which is money that is going to be coming into the economy. For that reason, I think that the 2023 economy, the GDP numbers, might be a lot better than we're expecting. I think the jobs data that we'll see is a lot better than we're expecting. And I also think that because of that, interest rates will probably be also higher than we expect. All right, so why don't I show you guys a chart of February in a pre-election year to give you a visual of what we can expect. What we can see from this chart here is during the pre-election year, the month of February is stronger than it normally is. It's the dotted lines that I'm referring to here. You can see how they kind of flatten out. Normally, February should sell off much further. And in fact, we actually are seeing that this year. this month. The market is pulling down really strongly in February. So this recent weakness might be a good time to take advantage of cheaper prices and a potentially longer rally later this year. Okay, now on to February. February, you are the weakest link. Okay, so what we're seeing is weakness in February, partly due to the profit taking from investors and traders from the huge gains that we've seen in the last month of January and all the way back into October 2022. But not only that, the CPI and the PPI data that we've seen and the Fed speakers with their hawkish tone have put a real damper and a real weakness in the month of February. So if we take a look right now at the month of February, what we can see is stock market reached a peak pretty much around February 1st, and ever since then has been trending sideways to down. Now, another thing that we want to take a look at is seasonality. What we can see from our seasonality chart is that February only closes up 45% of the time. In the last 20 years, going back to 2004 till now, February's only closed up 45% of the time. Whereas in March, the actual stock market closes up 63% of the time higher. And then taking a look at the seasonality chart here, we can see that in January, February, March, February is the weakest. March typically rebounds. So this weakness that we see here in February, we should probably take advantage of it. Also, according to the Stock Traders Almanac, in a pre-election year, March closes up on average 1.9%. That's 70 basis points higher than in February. So in the face of the Santa Claus rally, the first 5 days, the entire month of January, as well as the market bottoming in a midterm year in October, and this weakness in February, I think it might be a good time to accumulate stock in this overall medium-term, maybe short-term rally from October. There really hasn't been a good opportunity to accumulate stocks other than maybe November, December, and now in February. Okay, here's a stat that's gonna blow your mind. Since 1914, the Dow Jones has rallied almost 47% from its midterm election low to its presidential cycle high. That is a whopping almost 50% gain from October 2022. We've rallied maybe 10-15% from that low. We probably have another 15 to 20% further to go in this rally. Okay, but wait. Now, what are some real world issues that are facing us now in 2023 that can derail our bullishness? Right now, the big concern is inflation, CPI, jobs data, and where the Federal Reserve is going to take its interest rate. The inflation report from the week of February 14th and the 16th, we see that inflation is a lot hotter than we were expecting. So that has led market participants to think or believe that the Federal Reserve will raise rates more than we were originally expecting. I think about 25 basis points hike was in the books, and that was it. The Fed was going to hold. But this recent data makes the market believe that the terminal rate is actually much higher, and there might even be a 50 basis points hike later in the year. Even though Jay Powell recently said disinflation is occurring in many parts of the economy, the New York Federal Reserve president did mention that they want to see financial conditions not be so easy. So around October of 2022, there was easing of financial conditions. Stock market started to rally. Things were looking a lot better. But looks like the New York Federal Reserve president doesn't want things to be like that just yet. They want things to be very, very restrictive. And so that might be something that derails this stock market rally, is higher rates for longer and a significant deterioration in more parts of the economy. If we have disinflation already and rates stay high, there could be a strong chance that there's a manufacturing recession, something similar to 2015, 2016. But it's important to remember that inflation actually runs in cycles. Even though we've seen the trend for inflation coming down, there is a chance that it will be bumpy. It will come down, but there might be spikes of up mixed throughout. In the 5-year cycle of inflation as shown by the great trader Larry Williams, Inflation might peak around 2022, 2023, and reaching a low sometime around 2025 to 2026. So if inflation, however, is a lot hotter than we expect, I think the stock market rally might be derailed. If inflation is hotter than expected, it'll force the Fed to keep rates higher, and it'll make capital really expensive. So companies will find it harder to expand, making it a little bit harder to turn a profit, making it harder for your stock price to go up if your earnings are declining. From a political point of view, we have this debt ceiling issue in the United States. Although the Senator Schumer has said that they're going to come to a resolution, which I think they will because they always do, this whole debt ceiling thing is probably just a political stunt fiasco show. Probably another way for politicians to agree on how much money they can take out of the government. So I don't think we have much to worry about with respect to the debt ceiling because it would kill the currency, it would kill the credit rating for the United States as well. But that being said, there is something extraordinary going on where the Treasury Department is using extraordinary measures while the debt ceiling issue is being resolved, accounting maneuvers so that they can save money. Basically what it's doing is it's not investing in certain funds and keeping that money to make payments on its debt. Okay, so we've covered real world issues that can derail the stock market rally. We've looked at the weakness in February and how it might be a good time to buy historically. But remember, keep that all in mind where we've got the current weakness and we've got Federal Reserve actions, which is really driving the market. And these two things really need to come together for positive appreciation in the stock market or easy financial conditions. But we don't really have that yet. Next month, the month of March, will be really interesting for me, and maybe even going into April, because that is typically the strongest part of the 6 months in the stock market. And then starting in May, we start to see some weakness. So let's see how that turns out. Okay, that brings me to the end of the video. I hope you found it really informative, looking at the month of February and what it means for the rest of the year. I think 2023 has a lot going for it, but there are some risks on the horizon. Again, I hope you found this video interesting. Please hit me with a like and a subscribe. That would be greatly appreciated. We'll see you on the next one.